Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Friday, March 27, 2026. The tone was risk-off and it felt heavy. Oil and inflation fear squeezed the biggest growth names, and it looked like money was getting carried into the weekend with less exposure. Bottom line, the generals backed up, the close stayed offered, and the tape screamed, "Reduce risk, not buy the dip." On the S&P 500 Heatmap, it was a sea of red. The biggest boxes, Microsoft, NVIDIA, Apple, Google, Meta, Amazon, Tesla, were all meaningfully lower. So there was no index's fine illusion. The green was narrow, energy stood out, and a few defensive names managed to hang in steady to green. And that heat map matched the flow. Capital rotated the classic way for an oil shock tape, out of growth and consumer-exposed cyclicals and into inflation beneficiaries like energy. Then into the don't touch my earnings corner, staples, and selective utilities. Meanwhile, technology and communication services lagged, with discretionary and financials leaning lower too. Here's the tension underneath it. Every push higher in crude fed the feeling that inflation risk wasn't going away, and that kept pressure on near-term rate cut hopes. That's why duration-heavy tech took the hit, and why the Nasdaq underperformed. Nothing really got resolved here. This was more carry less risk into the weekend than a clean turning point. On the chatter side, the market traded like people were bracing for weekend headlines. But in today's captured notes, there weren't specific, verified rumor items driving the tape. So treat the narrative carefully. What we can say is positioning looked defensive, and the market behaved as if headline and policy risk mattered without a single confirmed smoking gun rumor. The AI gold rush just hit a major roadblock. NVIDIA, the undisputed king of the Blackwell era, is facing a perfect storm today. Even after Jensen Huang's GTC 2026 bombshell, talking up roughly $1 trillion in orders for Blackwell and Vera Rubin chips through next year, the stock is bleeding. Why? Because Washington's tightening the screws. A bipartisan push led by Senators Warren and Banks is calling for an immediate suspension of export licenses on fears that high-end silicon is getting diverted to China through Southeast Asia. Layer on a sell the news reaction after the GTC peak, and a broader rotation out of the so-called Magnificent Seven, and you've got a giant testing critical support around $165. Investors aren't just asking how much can you build anymore. They're asking, who are you allowed to sell it to? Tesla's starting 2026 in the rearview mirror. Today's roughly 3.3% slide isn't just a bad day, it's a wake-up call on a cooling market. Tesla just slashed its 2026 delivery forecast to about 1.69 million vehicles, barely 3% growth from last year. The so-called Juniper Model Y refresh was supposed to be the savior, but first quarter estimates near 365,000 units point to a painful, roughly 13% sequential drop from late 2025. The Cybertruck's still a niche player, and with federal tax credits drying up, the broader EV market has cratered almost 28% year-on-year. While Elon Musk pivots the story toward robotaxis and humanoid bots, Wall Street's staring at shrinking margins, a car company stuck in a brutal price war in Europe and China. For Tesla, the question for 2026 isn't reaching the moon anymore, it's whether they can hold the line around $380. Exxon Mobil, ticker EXOM, was one of the clearest green in a red tape tells, up just over 3.3%. The catalyst was straightforward. Crude strength tied to Iran war risk and Strait of Hormuz disruption fears. In a session where megacap growth was getting sold, that bid in Exxon reinforced the point: inflation fear, not stock-specific optimism, sat at the center of the day's positioning. Amazon, ticker AMZN, dropped just under 4%. The read-through in today's notes was simple. High beta megacap de-risking, with oil and inflation fear weighing on growth and on the big consumer winners. It mattered because Amazon weakness is a clean sentiment signal. This wasn't a careful rotation inside tech. It was broad, top-down selling pressure on the biggest, most-owned names. Microsoft, ticker MSFT, fell just under 2.5%. In the notes, this sat squarely in the duration compression bucket. Megacap tech got leaned on as oil and inflation stayed front and center. Microsoft matters because it's usually treated like a stabilizer. When it's offered with everything else, that familiar floor under broader sell-offs starts to disappear. JPMorgan, ticker JPM, dropped just over 3%. The notes framed it as financials liquidation on macro uncertainty and inflation concerns tied to energy prices. It's important because JPM is a system barometer. When it's down hard alongside the broader tape, traders read it as risk getting cut at the core, not just a sector story. Silver via the SLV ETF popped about 4.25%. In today's summary, it showed up as a classic precious metals bid tied to macro anxiety and inflation hedging demand. That fit the regime, equities down, megacap growth under pressure, and hard asset proxies catching a bid. Now, the setup into next week. The calendar is heavy. Monday, Fed Chair Powell speaks. Tuesday brings JOLTS and consumer confidence. Wednesday stacks ADP, retail sales, and ISM. Thursday is jobless claims. And Friday brings the jobs report, average hourly earnings, non-farm payrolls, and the unemployment rate. After a session dominated by oil-linked inflation anxiety, those prints are the near-term checkpoints the market's going to react to without assuming the direction ahead of time. To wrap it up, this was a risk-off Friday, with the biggest weights participating on the downside, and the market hiding in energy and defensives. The key tells from here are simple: what oil does, whether the megacap generals can regain their footing, and whether breadth improves beyond that narrow green corner. Next week's macro tape gets plenty of chances to move sentiment again. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.